Nigeria Revenue Administrations enter a decisive new phase as the federal government officially launches the Nigerian Revenue Service, marking a full transition from Federal Inland Revenue Service to a unified Federal Revenue Authority. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. The activation of the NRS follows the provision of the newly enacted tax law and represents a major institutional reform aimed at strengthening revenue mobilization, improving fiscal governance, and supporting sustainable national development. In a statement signed by the technical assistant to broadcast media to the executive chairman, Arabirin Aderonke Atoyebi, reveals that the Nigerian Revenue Service is not a mere rebranding of the formal system. It is a structural transformation designed to modernize how federal revenues are assessed, collected, and managed and reported through integrated system and streamlined process. The NRS is positioned to enhance government planning, optimizing public investment, and build a more resilient national economy. This reform reflects the federal government's long-standing commitment to technology-driven, efficient, and transparent revenue framework aligned with Nigerian economic fiscal strategy. Despite the institutional transition, the core mandate remained unchanged, mobilizing federal revenue to fund national development. The service continued to operate on the principle of professionalism, integrity, fairness, and service to the nation. Staff across all offices and regions of the Federation remain central to the success of the system. The statement explained that what distinguishes the NRS is a stronger delivery framework built on accountability and transparency. The service introduced a harmonized structure that simplifies compliance, improves service delivery, and provides clearer engagement pathway for citizens and businesses. As Nigeria Unified Federal Revenue Authority, the NRS offers taxpayers a more coherent and accessible system for understanding obligation and complying with the law. Its operations are anchored on fair enforcement, transparent process, and accountability administration without favor or fear. By embracing innovation and modern administrative practice, the Nigerian Revenue Service is strategically positioned to support long-term economic growth while strengthening trust between government and taxpayers. The Nigerian Revenue Service reaffirmed its commitment to effective service delivery and responsible revenue administration in support of sustainable national development. Nigerian banking sector saw a noticeable jump in a bad loan in 2025 after the Central Bank of Nigeria rolled back regulatory forbearance introducing during the COVID-19 crisis. The move aimed at restoring normal prudential standards as exposed loan weaknesses that were previously marked by temporary relief measures. According to the CBN latest macroeconomic outlook, the industry non-performing loans ratio rose to about 7% above the regulatory benchmark of 5%. The increase followed the withdrawal of the pandemic-era permission that allows banks to restructure stressed loans without classifying them as bad. With that window closed, several structures facilities have now slipped into performing status despite the spark in the bad loans. The Apex Bank insists the financial system remained broadly stable throughout 2025. Bank maintains strong liquidity, averaging about 65%, well above the 30% minimum, while capital adequacy stood at roughly 11.6%. Also above the required threshold. These buffers, the CBN noted, give lenders room to absorb shock. The central bank linked the sector's resilience to stronger interest income expanding digital banking operations, and the ongoing recapitalization program. The recapitalization drive, which raises minimum capital requirements, is expected to reinforce banks' balance sheet and position banks to fund larger projects in the real economy. Market confidence also held up during the year, supported by tighter macro-prudential rules and closer regulatory oversight. The bullish run in the capital market reflected renewed investors' interest in the financial stock. Still, the rise in the NPLs points to emerging risk, especially as high-risk interest and tough economic condition pressures some borrowers. To address this risk, the CBN has pushed for stricter credit discipline, including deeper integration of the global standing instructional framework across all financial institutions to improve loan recovery. Better repayment performance, the bank believes, would support MSMEs and retail lending while helping bank cut losses and build stronger capital buffers. Monetary conditions remain tight for most of 2025 as the CBN focused on price and exchange rate stability. After aggressive rate hike in 2024, the monetary policy rate was only slightly eased in September 2025, following signs of improved economic stability in June 2025. The CBN also issued fresh directive to banks still operating under regulatory forbearance. These lenders were told to suspend dividend payment, defer executive bonuses, and halt investment in foreign subsidiaries or new offshore ventures until the capital adequacy and provisioning level are fully verified. The move was designed to conserve capital and strengthen balance sheet resilience during the transition out of forbearance. Investment firm Resilience Capital, backed by the CBN, stands estimating that several major banks still carry sizable forbearance exposures. The firm noted significant exposure level at some top-tier lenders, while others had already fully provisioned and existed forbearance. In absolute terms, it estimated forbearance-related exposure running into hundreds of millions of dollars across several banks, raising concern that some institutions could breach single obligors limit. Analysis shows that the rise in the bad loan is less a sign of fresh stress and a more delayed reckoning after years of regulatory relief. While headlines NPL numbers have worsened, strong liquidity, recapitalization, and tighter supervision suggest the system can cope. The real test will be how quickly banks can up legacy exposure while supporting growth in a still challenging economic environment. Economic activities in Nigeria accelerated sharply in December 2025, closing the year on a strong note as the CBN, as the Central Bank of Nigeria Purchasing Managers Index climbed to 57.6 points, the high level recorded in 2025. The increase from 56.4 points in November signals a stronger and more broad-based improvement in business conditions across sectors of the economy. According to the CBN December 2025 PMI report, the latest reading marks the 13th consecutive month of expansion, underscoring sustained growth momentum despite a challenging macroeconomic environment. The breadth of the recovery was evident, with 32 out of 36 subsectors surveyed reporting expansion during the month. The industrial sector led the upswing, posting PMI of 57.0 points, its strongest expansion since March 2020. 14 of 17 industrial subsectors recorded growth, reflecting rising production level, improved supply condition, and stronger demand across manufacturing and related activities. The service sector also maintained solid momentum, with its PMI at 56.4 points, marking the 11th straight month of expansion. 13 out of 14 subsectors surveyed reported increased business activities, highlighting the sector's resilience and its growing role in driving overall economic performance. Agriculture remained a key pillar of growth, recording a PMI of 58.5 points and extending its expansion streak to 17 consecutive months. All 5 agricultural subsectors surveyed experienced growth in December, reflecting improved output and sustained activities across the value chain. The report also shows that input price indices for the composite PMI and its major sectors, industry, service, and agriculture, remain higher than their respective output price indices, pointing to the continued cost pressure of businesses. Analysis shows that the December PMI reading suggests that Nigerian economic recovery gained significant traction at the end of 2025, driven by broad-based sectoral performance. Strong expansion in industry, services, and agriculture points to improving demand and business confidence. However, persistent input cost pressure highlights the need for continued policy support to manage inflation risk and protect profit margin, even as growth prospects remain positive ahead into 2026. Nigerian money supply rose sharply in November 2025, underscoring growing liquidity in the financial system, even as the Central Bank of Nigeria maintained a cautious monetary stance. Broad money supply entry climbed to 122.95 trillion naira in November from 119.04 trillion naira in October, reflecting sustained expansion in credit and improved external inflow. Latest data from the CBN shows that M3 increased by 3.91 trillion naira month on month, by nearly 14 trillion naira compared with November 2024, when it stood at 108.97 trillion naira. This points to the strong rebound in liquidity condition and deeper financial activities across the economy. The expansion was driven by growth in both net domestic assets and net foreign assets. Net domestic assets rose to 85.57 trillion naira in November from 84.23 trillion naira in October, indicating higher banking sector claims on government and increased lending to private sectors. This trend suggests rising credit demand and greater domestic economic activities. Net foreign assets recorded an even stronger improvement, increasing to 37.38 trillion naira in November from 34.80 trillion naira in October. On a year-on-year basis, NFA more than double from 17.35 trillion naira in November 2024, highlighting stronger foreign exchange inflow and improved external buffers. Other monetary indicators followed the same upward trajectory. Broad money measured by M2 edged up to 122.94 trillion naira from 119.03 trillion naira, while narrow money M1 rose to 40.53 trillion naira from 39.35 trillion naira, reflecting higher transactional balances and increased spending activities in the economy. The rise in the money supply comes amid recent monetary policy adjustment. In September 2025, the Monetary Policy Committee reduced the monetary policy rate by 50 basis points to 27%, responding to easing inflation pressure and improved foreign exchange condition. However, the committee held the rate steady at its November meeting, signaling cautious as liquidity continued to expand. The combination of the rising domestic credit and improving foreign asset positions support economic growth and lending, but also present policy challenges. Expanding liquidity, if not carefully managed, could fuel inflationary pressure or destabilize the exchange rate. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Points, where we extract the Nigerian economy and the government policies. A quick look at the stock market and other stories before we call it a wrap on this business segment today. Foreign investors remained cautious in November 2025 as equity transaction on the Nigerian Exchange Limited stayed below the 200 billion naira mark for the second consecutive month, underscoring subdued offshore participation despite improved market activities overall. Despite data from the NGX domestic and foreign portfolio investment report shows that foreign equity trade declined by 13.2% month-on-month to 162.04 billion naira in November 2025, down from 186.62 billion naira in October. In dollar terms, transaction eased to about $112 million from $131.3 million, reflecting both lower volumes and the impact of exchange rate movement at the Nigerian Autonomous Foreign Exchange Market. The sustained moderation in foreign trade points to lingering concern among offshore investors, including currency risk, capital repatriation challenges, and broader global risk aversion. Overall, market activities also softened slightly during the month. Total equity transaction on the NGX fell by 5.9% to 971.18 billion naira in November from 1.03 trillion naira in October 2025. However, the bigger picture remains positive, compared with 442.34 billion naira recorded in November 2024. Total trades more than double year-on-year, highlighting a strong recovery in market turnover. Domestic investors continued to dominate trading activities, accounting for about 83% of total transaction in November. Domestic trade stood at 809.14 billion naira, only marginally lower than October level, reinforcing the role of local capital as the backbone of market liquidity. A closer look at domestic participation reveals contrasting trends. Retail investors' activities weakened, with transactions falling by 16.2% to 277.93 billion naira, suggesting some caution among individual investors. In contrast, institutional investors increased their trade by 3.3% to 531.21 billion naira, decisively outperforming retail players and sustained market momentum amid weak foreign inflow. On a year-to-date basis, total equity transaction reached 10.54 trillion naira by November 2025, more than double the 4.91 trillion naira recorded in the same period of 2024. Domestic investors accounted for 8.35 trillion naira, that is about 79% of the total, while foreign investors contributed 2.19 trillion naira, representing nearly 21%. This indicates that despite recent monthly weaknesses, cumulative foreign participation in 2025 has improved compared with last year. Longer term trends further confirm the growing importance of domestic capital. Over the past 18 years, domestic transactions have expanded steadily, and by 2024, they accounted for about roughly 85% of total equity trade, a pattern that has largely continued in 2025. Nigerian manufacturers significantly cut their reliance on bank loans over the past years, repaying about 2.17 trillion naira as soaring interest rates and rising production costs squeezed the sector. Latest figure from the Central Bank of Nigeria shows that credits to manufacturing fell sharply from 9.26 trillion naira in June 2024 to 7.09 trillion naira in June 2025, a 23.5% decline year-on-year. This contraction occurred even as total private sector credit expanded, meaning manufacturers took a much smaller slice of available bank lending. The sector shares of the total private sector dropped from 16.63% to 12.19%, the lowest level in the period under review. The data point to the aggressive deleveraging by manufacturers as borrowing costs remained at the historic high and operating pressure intensified. Throughout 2024, the CBN raised interest rates repeatedly, pushing the monetary policy rates to 27.5% to curb inflation and stabilize the naira. Although the tightening cycle paused in 2025 and the benchmark rate was trimmed lightly to 27% in September, lending rates have remained elevated, discouraging new borrowing. Monthly trends highlight this trend. Manufacturing credit fell steadily from 8.31 trillion naira in January 2025 to 7.09 trillion naira by June, while the sector shares of the total lending slide from 14.18% to 12.19%. This contrasts sharply with early 2024, when manufacturers' bank exposure exceeded 10 trillion naira and accounted for up to 18% of the private sector credit. Manufacturer says lending rates of 30 to 37% mark long-term industrial investment unviable, forcing firms to prioritize debt repayment over expansion. Industry groups warns that unless borrowing costs ease further, the sector will continue to shrink its balance sheet exposure, limiting output growth, job creation, and competitiveness. All right, this is where we draw the curtain on Business Point today. Join me again on Monday on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.